Welcome back to the deep dive. Today, we're putting Bloom Energy Corporation, that's BE, under the microscope.
Yeah, they just dropped their Q3 2025 financials dated October 28th. And, well, the numbers are big.
Big, and they tell a story, right? A story about a pretty fundamental strategic pivot. Seems like it's all driven by one thing, AI.
That's really the heart of it today. So for you listening, our mission is, to quickly break down these impressive highlights, sure, but maybe more importantly, to understand this huge shift they're making towards AI infrastructure.
Okay.
And we also need to look at the trade-offs, right? The stability they're getting from new regulations versus, well, the costs involved in their own rapid product development. It's not all smooth sailing.
Right, let's hit those high wattage headlines right away then. I mean, fourth consecutive quarter of record revenue, $519.0 million.
Yeah, pretty stunning number.
And it's not just volume. Their services side second quarter in a row, hitting double-digit non-GAAP profit margin percentage.
Which is significant for them.
Definitely. And the CEO, K.R. Sridhar, he didn't mince words, claimed Bloom is at the center of a once-in-a-generation opportunity to redefine how power is generated and delivered. Bold stuff.
Well, when you see why they're growing, maybe it's justified. I mean, what makes this quarter really stand out isn't just the final number. It's the strategic anchor, you could say, the surging demand for electricity, specifically driven by AI and data centers.
Okay, so let's start unpacking the financials then. Just how big was that jump, that top-line growth, compared to last year? Give us some context for that $519 million.
Oh, it was dramatic. Total revenue, it spiked over 57% year over year, jumped from $330.4 million in Q3 24 to the $519 million this quarter.
Wow, okay.
And if you look at the core business product and service revenue, it basically tracked right along with that, up 55.7%, hitting $442.9 million. So this wasn't just, gradual growth. It feels very demand-pulled.
And crucially, that efficiency, did it show up in the margins? I mean, did their costs balloon with this massive new volume, or did they manage it?
They did manage it, and that's really key. It suggests maturity. Their GAAP gross margin, it rose quite a bit, hit 29.2%. That's 5.4 percentage points up from 23.8% a year ago. And the non-GAAP gross margin was even a bit higher, 30.4%.
So the unit economics are holding up, even improving.
Exactly. It confirms the scaling is, healthy. They're stabilizing at a higher, more profitable level.
Okay, but the real indicator, I think, for profitability watchers is that swing to operating income, going from losing money operationally to making it.
That's right. And they did it. They went from a GAAP operating loss of $9.7 million last year, Q3 24, to a GAAP operating income of $7.8 million this quarter. Right. That's almost an $18 million swing year over year just on operations.
Significant turnaround.
Yeah, and if you strip out some of the noise, the non-GAAP number.
Even sharper.
$46.2 million in non-GAAP operating income. It's way up from $8.1 million last year.
Yeah.
Really shows the underlying strength.
We should probably touch on the services segment too, because that's often seen as, a drag or at least a high-cost area for these kinds of companies.
Exactly. And hitting that double-digit non-GAAP profit margin, like you said, for the second quarter running, that signals that the economics of maintaining their deployed fleet are getting better.
Okay.
They're not just stabilizing. They're becoming a reliable, profitable income stream. The service segment GAAP gross profit actually went from a loss last year to a profit of $6.8 million. That's a 12% gross margin.
So that gives them a nice steady base to balance out the big hardware sales.
Right, like a long-term annuity business.
Okay, strong foundation.
Yeah.
But we have to circle back to what drove that $519 million number.
Yeah.
We need to talk about this AI power play, because that seems to be where the huge opportunity and maybe the risk really lies.
This is absolutely the core shift. Yeah. The CEO, he wasn't exactly subtle about the tailwinds, right? This explosion in AI demand is just fundamentally outstripping the grid's ability to keep up, both power and infrastructure. And this leads to what they call time-to-power challenges.
Time to power, which means...
Well, think about it like this. If you're a big tech company, a hyperscaler, and you need to build a new data center, waiting, say, 3 years for the local utility to upgrade everything.
Right, the substations, the lines.
Exactly. That delay could cost you billions in lost opportunity. The grid is just too slow for the pace of AI development.
Okay.
So Bloom comes in and says, look, we can get you plugged in basically today, bypassing that whole utility queue.
Yeah.
That speed, that immediacy is worth a fortune to these data center operators.
And they locked that value proposition down with that huge Brookfield Asset Management partnership, right? Announced back in August, the $5 billion AI infrastructure deal.
Correct. That's the mechanism. It's structured through joint ventures. They're housed in something called the AI Fund.
Yeah.
And this basically lets Brookfield, one of the world's biggest infrastructure investors, finance these large-scale Bloom deployments specifically for these really time-sensitive AI projects.
Okay, so let's talk about the immediate impact. What did launching this partnership actually do to the Q3 revenue numbers? Was it immediate?
Oh, it wasn't delayed at all. It basically defined the quarter. You look at related party revenue.
Which in this case means?
Sales of their energy servers directly to these Sun JVs, the ones they set up with Brookfield. That line item totaled $288.0 million just for Q3.
Wait, hang on. $288 million out of a total revenue of $519 million.
Yep.
So this one single brand new strategic category selling to their own partnership fund was roughly 55% of Bloom's entire record revenue for the quarter.
That's it. It is a fundamental reweighting.
Yeah.
Happened almost overnight.
Well.
And yeah, related party sales can sometimes, raise questions. But here, it seems to me they're selling into the financing vehicle they helped create with Brookfield. It gives them control, ensures the tech goes straight to where that high-margin, urgent demand is, AI data centers.
But doesn't relying over half your revenue on one new strategic stream, doesn't that introduce a massive concentration risk? What if that AI fund demand hiccups or the timeline slips?
It absolutely does. It's a risk shift, away from maybe broad market diversity towards execution risk within one, albeit huge, partnership.
Okay.
The trade-off is clear. Potentially high reward, but tied to high concentration. But look, given the urgency they're tapping into selling power in months instead of years, maybe this concentration is a strategic necessity right now. They're choosing speed and scale over diversity, at least for the moment, to grab this AI niche.
Okay, that context helps explain the record revenue. But this kind of high-growth innovation, it often comes with a hefty price tag somewhere else, right?
Yeah.
Where did we see the cost of, say, rapid R&D or maybe product cycles biting them in the Q3 results?
Yeah, you saw it pretty clearly, actually. Despite the fantastic revenue, the company booked a pretty substantial charge, a $19.7 million inventory reserve in Q3.
Okay, $19.7 million. Related to what?
Related to their first-generation electrolyzer inventory.
Electrolyzers. That's their hydrogen-producing tech. Key to the future vision. So is a nearly $20 million write-down just like the cost of innovating in that space?
Yep.
Or does it maybe signal a misstep in their hydrogen plans or R&D focus?
It's probably a bit of the cost of being an aggressive innovator who has to prioritize ruthlessly. They stated they ceased efforts to market and sell that first-gen product, and they recognized the expense right there in the cost of product revenue. It really highlights this central tension for Bloom, doesn't it? They've got this immediate cash cow, the energy service for AI that needs focus and resources, but they also have to make these huge, expensive bets on the future, like hydrogen.
Right.
And when one of those early bets doesn't quite pan out in terms of quality or scalability, well, they cut it. And this time, cutting it cost nearly $20 million.
Okay. Now, shifting gears a bit, on the brighter side of external factors, it sounds like the regulatory world finally gave them some much-needed clarity. That's usually huge for financing these long-term projects.
Oh, this is massive. Yeah, particularly for projects outside the immediate AI boom. We're talking about the One Big Beautiful Bill Act, or OBBA.
Right, the OBBBA, enacted July 4th, 2025.
Yeah, and what this does is provide something absolutely critical that Bloom, frankly, hasn't had consistently for years.
Yeah.
Regulatory certainty, runway.
And what's the specific change that helps them?
It brings back the investment tax credit, the ITC, for fuel cells. Restores it to a full 30% for projects starting construction after the end of this year, after December 31st, 2025.
Okay, 30%.
And the clarity part is huge because that 30% credit, it's locked in, fully available, all the way through 2033.
Ah, okay.
That stability lets Bloom, and more importantly, their financiers, structure these, 8 to 10-year power deals with confidence.
Yeah.
No more worrying if the credit's going to expire mid-project.
Got it. And speaking of strategic shifts, these regulatory tailwinds kind of reinforce a move away from some older partnerships too, don't they? I think we need to mention the sort of symbolic end of the SK EcoPlant relationship.
That's a really good point.
Yeah.
Yeah, the SK EcoPlant situation is a stark contrast to the new Brookfield relationship, isn't it?
How so?
Well, SK Ecoplant's ownership stake dropped way down to just 2.9% by the end of September, and officially, as of July 10th, they are no longer considered a related party.
Right. Big change from how things used to be.
Absolutely. It signals a clear evolution, doesn't it? Bloom's moving away from relying so heavily on that one long-term international partner that really defined their earlier growth phase, and pivoting hard towards capitalizing on this massive, immediate, and largely U.S.-focused demand for AI power.
Makes sense. Okay, let's wrap up with the liquidity picture. Massive revenue, strong margins. How did that translate into cash flow for the quarter? Did the cash roll in?
Well, from a liquidity standpoint, the balance sheet looks pretty healthy. Cash and equivalents were sitting at $595.1 million. And the big news was definitely the positive cash flow turnaround within the quarter itself.
Okay, can you put a number on that turnaround compared to last year?
Sure. Net cash provided by operating activities was $19.7 million for the 3 months ending September 30th.
Okay, positive $19.7 million.
Right. And that's a huge swing compared to Q3 24 when they actually used $69.5 million in cash from operations. So big improvement quarter over quarter.
So cash flow positive for Q3. That's good. But if you zoom out, look at the first 9 months of 2025. Is this massive growth strategy still burning cash overall?
It is. Yeah, that's the context check. While Q3 was positive, the net cash used in operating activities for the full 9 months ending September 30th was still substantial, $304.1 million used.
Okay.
So this really shows a company still acting like it's in hyper-growth mode, right? Pouring hundreds of millions back into working capital, building up inventory, dealing with accounts receivable, contract assets, all to fuel that expected future demand. They're spending heavily to scale up for this AI opportunity.
Right, investing ahead of the curve. And just quickly, they also tidied up their debt profile a bit earlier in the year, didn't they? And pushed some maturities out.
Yes, that was the debt exchange back in May. They essentially swapped about $113 million of their older 2.5% green notes.
The ones maturing soon.
Right, for about $116 million of new 3.0% green notes that aren't due until June 2029. Smart move. Buys them 4 more years of runway on that chunk of debt. It did trigger a non-cash accounting thing. A $32.3 million loss on early extinguishment of debt had to be recognized. But financially, that certainty and the extended timeline, probably well worth that accounting hit.
Okay, so let's try to synthesize this quarter for everyone listening. We've got this narrative really defined by incredible success, record revenue,
Yeah.
driven overwhelmingly by this strategic bet on AI infrastructure, channeled through the new Brookfield partnership. I mean, a move that reshaped 55% of their revenue base practically overnight.
Right, and that pivot gets a tailwind from long-term regulatory stability, thanks to the OBBA.
It's a story of incredibly fast deployment to meet very immediate, very high-value market demand.
Exactly. But the critical footnote, maybe, is that $19.7 million write-down on the first-gen electrolyzers.
Right.
It's just such a vivid reminder that, okay, the AI boom is funding their prison operations beautifully, but the cost of actually securing that longer-term clean energy future, it's steep. And it involves making some pretty tough calls about which innovations you pursue and which you cut loose.
Yeah, that tension is fascinating. The immediate, super lucrative, almost short-term feeling AI cash grab versus the long-term, expensive, world-changing hydrogen bet.
Yeah.
This whole quarter just embodies that conflict.
It really does. And that brings up, I think, an important question for you, the listener, to maybe ponder as you watch Bloom going forward. Given this huge immediate demand for AI infrastructure, the thing driving their $5 billion opportunity with Brookfield, which requires rapid, stable deployment of their existing energy service. How are they going to maintain the internal focus and, frankly, the funding for the relentless, costly innovation they also need in their bleeding-edge portfolio? You know, next-gen electrolyzers, maybe future carbon capture tech. How do they do that without sacrificing the stability and execution needed right now for the AI deals? It feels like the sheer scale of the AI boom is accelerating their present. But is there a risk it distracts them or starves resources from their ultimate future?
A classic innovator's dilemma, just on a massive scale. Really interesting stuff to watch. Thank you for diving into the sources with us today.
My pleasure.
We'll catch you on the next Deep Dive.